Alright guys, GS Romeo here, and today on this video I'll be explaining and breaking down what risk management is and also how to manage your trade. Depends on the account size and also your risk per trade. But firstly, on this short video, let's start with risk management, right? So risk management is very important when it comes to trading. But many traders don't really understand the excess of risk management. Now, some traders think that risk management is to avoid large losses, one, and secondly, some think that it's to protect emotions. But honestly, this is merely the secondary effect and not the excess of risk management. Why did I say this? Now, this is the reason why I said this. Now, to make probability work in a world of uncertainty, we know in the forex market we deal with probability and nothing is certain. Both your losses and profits, nothing is certain, right? So to make probability work in this world of uncertainty in which we're trading, right? All you need is a sufficient sample size. Now, what do I mean by sufficient sample size? You hear traders be like, okay, I do go 1:3, at most 1:4, max 1:5. One ratio, this one ratio five, one ratio, whatever ratio they are going for. Now, these are own sample sizes. Now, traders don't make money on a single trade. Now, you think long term, you compound, right? They think long term, they compound profits from these sample sizes, maybe 1:3, 1:4, 1:5. Now, with this in mind, the main aim and objective of risk management in this trading space is to ensure that the system operates stably for you and safely over a long term period with zero risk or bankruptcy. So that's the reason why we we say okay, apply proper risk management this, risk management that. Because if you fail to understand that okay, you're managing risks because you want to trade for a very long time, if you fail to understand this, then you end up blowing accounts back to back, back to back, back to back. But when you understand, okay, you want to be in this system for a very long time, you want to be in this system for a longer period of time, you understand that, okay, then there's a reason for you to like calm down and then manage risk and then make money over a long period of time, not just for not just on a trade. Now, people be like, how can I avoid unexpected losses? The truth is, it's normal. This market is uncertain, right? Both the stop loss and the profits are unavoidable. No matter who you are, no matter how good you think you are in this market, you cannot avoid stop losses. It's necessary for you to now understand that, okay, I want to manage risk because I want to be in the game for long. I don't want to blow my accounts. I think with this simple thing, we've understood what risk management. This video will be very short. We've understood what risk management is. You want to be in the game. It's not because you want to like avoid this, you want to avoid that. Now, the basics which this risk management ought to me, I've broken it down to you to have a sample size you're using to trade, right? You have a sample size. Now, let's go into trade management, which I said we'll talk about trade management. Let's talk about trade management now. Now, management. What's trade management? Trade management. Let's say you're already on the trade. Let's look at this. Let's look at this chart, for example, where this is on EU. Let's say you're already on this trade. Now, this is a sample size for me. The sample size, this three RR, this three RR sample size, right? Now, let's say I have an account. My account size, my account size is, let's say my account size is $500. I have a $500 account. I have a $500 account size, right? And I want to be trading. Now I know how to trade, right? I've already gotten the skills, which is the first thing. I've gotten the skills already. I can trade. Now I want this $500 to like make sustainable profits over a long period of time. And now, how much am I going to risk per trade if I'll be going with 1:3 on each trade I want to like go for. Now per trade, now let's say on this $500, I want to be risking just $25 per trade. I want to be risking $25 per trade. That's to say I have 20 trades to take on this $500 account, right? I want to be risking just $25 per trade. 25. So I want to be risking just $25 per trade. This is what I want to be risking per trade. Right. So I've gotten my analysis there. Okay, I'm bullish on EU, and price gave me the confirmation I needed, and then I executed my trade. I put my sample size, which is your risk management, as I've explained earlier. This is 3RR. So I wanted that, okay, this is my stop loss from here to here will be $25. I'm not risking more than $25 on this. I'm not risking more than $25 on this. I'm not risking more than $25. So from here to here will be $25. Now the price came and then it tapped me into this trade, right? Now this is why we should three. Now that's to say I'm having TP1, TP2, and TP3, right? Let's say this one. Let's say this one. Yeah, let's say this one. This TP1. These two. Yes, these two, this TP2, and then this TP3. Yeah, let's say this TP3. So this TP1, let's say these are TP1, TP1, CP2. So now you're risking just $25 per trade, and you've executed your trade. Trade has already tapped you in, and now you're in the trade. Now this is where my stop loss was, right? And I reached $25. Now when price moved to CP1, that's 1:1. That's 25 plus. That's $25, right? When price move 1:1, that's $25. Now from this point here we have $25. This is 1% already. Now if I want, now some people are there that they don't actually move SL. It's TP or SL. That's what I've been working for them and they enjoyed it that way and they've been doing it, right? Now, if you're that type that okay, you can't hold from the stop loss level to TP or whatever. Now let's say price already moved 1%, right? When price already moved 1%, you can adjust your SL to either half. You can cut it half. You can cut your SL half, maybe to 12 point something dollars. Let's say this point, you can adjust your SL to this point, maybe 12 point something to reduce the risk. Reduce the risk. Or you break even when price already gone 1%. Your choice. You go half or break even. Now you wait again for price to move to 2%. When price moves to 2%, you can adjust your SL from break even. Maybe you wait, you wait, you wait for price to price don't go on a straight line. It might definitely retrace. You wait for a retracement. When price retrace, and then take another leg, and okay, that's created another high low. You can adjust your SL to that high low and then make your trade flow freely to TP. And if you want, you can just leave your trade when you execute when it taps you, you can leave it from A to Z from beginning to the end. It's very short and very simple. I believe you understand this. We understand this concept of trade management. When it taps you in 1:1, on 1:1, you adjust your SL to break even. On 1:2, you wait for either correction or whatever, and then you adjust also to those minor structure that has been created by the market, and then let the price flow to TP. That's how it is for you to manage your trade. But if you don't want to do it that way, adjusting your stop loss, it's better you just leave your trade since you already made up your mind to risk $25.